The advanced investment team comprises 15 investment professionals. On average, each of these investment professionals has 19 years of experience. Experience very much counts in these sorts of market conditions, because unless you've been through these sorts of market conditions, unless you understand the interplays that are happening, you can never really truly assess the risk involved with actually managing people's money. And we do that, and we've got a variety of backgrounds in each of the individuals as well. Having those different backgrounds means that we can get different perspectives on what's happening around the world. And we can distill it down into what really makes sense for an investment portfolio. We are very much here to make money. We are very much here to protect against risks in an investment portfolio. We understand who we are managing money for, and that's the key criteria. You know, we're not here to take unnecessary risks. We are here to actually assess and understand what's going on in the world, and having a team of experienced individuals means that we can do that and actually assess it properly. We believe that we do have a unique process, and it's one that is based on having high conviction type calls in our portfolio. We spend a lot of time focusing on what are the important investment decisions. Asset allocation is one of the most important ones. You know, if we can get our asset allocation right, both from a return generating perspective, but also from a risk management perspective, then we've done the bulk of our job. Implementing these asset allocation decisions through a multi-manager process is also a very important risk control, and it's one that delivers return consistency. So we are all about delivering active return, but in a more consistent nature than our competitors. And we believe that our process is akin to that. The way that we blend our managers together is also an important part of the process. We're not out there looking for the best managers in the marketplace. We don't look for a team of individual stars. We look for a star team, and that's the best analogy to make. So making that decision means that we don't necessarily just take who are the best performing managers in a particular sector. We will actually look and see how the interplay between these managers actually occurs, and what managers are going to do well in what certain environments. We need to have a good blend of managers in order to deliver on that return outcome, and that's one of the most important things. Managing risk is part of our key priority. It is so important to be able to assess risk at every investment decision level. So all the way from asset allocation down to what managers that we choose and what sort of tactical positioning that we put in place. All these decisions incorporate a degree of risk management. At the asset allocation level, it is important, it is one of the most important decisions to actually make in relation to how we manage risks. Because the decision to actually implement either a commodities exposure or our fixed income exposure all comes down to what are the key metrics that we're trying to achieve for that particular asset class within the portfolio that we manage. So it's not just about let's just put our money with a high returning expectation. It's about managing some of the shorter term risks or some of the geopolitical risks around the world at the moment. These are one-off type events. If we have a portfolio that's set up in such a way that can actually benefit from some of these one-off risks that could occur, then that's a great outcome, so long as we're not compromising the return characteristics that we're trying to achieve. Risk can be incorporated into what is rewarded and what is unrewarded. So a lot of the asset allocation calls that we make are typically rewarded risks, so we would expect a higher degree of return for some of the risks that we're adopting. Some of the unrewarded risk components, and these have come down into some of the other decisions that we make, particularly around choosing some of the managers. What happens if a manager blows up? What happens if there's fraudulent activity within a manager? Our due diligence process tries to identify that whether or not there is the right governance processes within a manager, whether or not they've got enough backing from their parent companies, or whether or not they are aligned to the actual return objectives that we're trying to achieve for our underlying clients. That's the most important thing. These are unrewarded risks, but they're very important in the degree in which we try to assess whether or not we're going to be able to achieve our objectives. So managing rewarded and unrewarded risks is a very big part of our particular process. So the investment management selection process is a very important part of our overall process. First off, we have a top-down, broader view of what's going to happen in the marketplace. Now, in order for us to actually implement that appropriately, we need to share that view with our underlying managers to some degree. But we also need to find managers that will potentially benefit from the conditions that we expect in the future. Now, not all managers have the same process. They all think differently. They all have different and unique aspects in order that they bring to the overall portfolio. It's important for us to incorporate some of those diversification aspects within a manager's process. We don't necessarily want to just follow the pack. We definitely don't want to basically concentrate an investment process into a particular style. Because even though that may have worked and that those managers may have delivered performance over the last 3 or 5 years, the next 3 or 5 years in terms of investment returns are going to be very, very different. The environment itself might not be conducive to their process going forward. So we're very conscious of the fact that performance is not a driver of our selection process. How they get their performance is a major driver. So actually understanding what the performance attribution, how they've been able to generate those returns, how that translates into what we consider to be the future to be, that's one of the most important aspects in terms of delivering what our actual blend of managers should look like. Again, we're not looking for a bunch of star players in our team. We are basically looking at how do we actually create a team that's going to deliver on its objective. And the objective is consistency of our performance. That's what we need to be able to deliver, no matter what the market conditions. And so the managers that we choose in the portfolio don't necessarily need to suit our view of what the market's going to look like, because we could be wrong. And if we are wrong, we need to be able to respond quickly. And that means we need to have a mix of managers that have a different degree of processes. And if we do get it wrong and we reassess what's happening around the world, then we can actually change the allocation in the portfolio in order to actually meet the objectives that we need to for each of the sectors. Being able to respond to what's happening around the markets at the moment is particularly prevalent at this stage. The market dynamics are very, very fluid, and it is so important to be able to have a process where you can actually respond and change and alter and adapt to the market conditions that we're seeing. In the next 3 years, we'll be having a very different conversation potentially about what the future is going to look like. However, in this sort of circumstance, we need to be able to adapt to those changes. Having a fixed process and having a very inflexible process is not going to work. The market dynamics at this particular stage, and the one that's going to sort of play out over the next 3 years, is going to be how we determine the market opportunities and how we actually assess and how we attain those opportunities. How do we position a portfolio such that we can actually extract some of those opportunities into the returns for our clients? That's the most important thing. But the flexibility piece is also so important in the risk management, because the market dynamics can change very, very quickly in this sort of environment. We will react to changes if it changes our outlook for what the future holds. And we're not necessarily going to get it right at every particular point in the cycle. We need to be able to adapt to the market changes. And if we have a portfolio which is flexible, and we have managers that are able to adopt a greater degree of flexibility in the way that we structure their mandates, then it's essentially what's going to be able to deliver the best outcome for our clients.